Hello and welcome to FBN Charting Points, a technical look at ag markets. My name is Brian Como. Today is October the 19th, 2023. We are recording this morning at 3:22 p.m. Central Time or 2:22 Mountain Time. Going to go through a disclaimer and then I'm going to share with you a little bit of a different approach to this presentation today. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material provided is as is and for informational purposes only, and it is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties express or implied as to the accuracy or completeness of the statements or any information contained in the material, and any liability therefore is expressly disclaimed. Of course, past results are not necessarily indicative of future results. Okay, on the call with me today, it's a little bit of a different format today. I've got Josh McClure on the line here. He's one of the senior risk management advisors with FBN Brokerage or FBN BR. Welcome, Josh.
Thanks, Brian. Great, glad to be here.
So, we talk fairly often, almost daily, I would say, and you have some really good insights today on soybeans and even corn. Both of them had very, very good days today, I would say, if from a bullish standpoint, or at least from a farmer standpoint. I personally believe that when we look at technical analysis, that charting is really just a graphical representation of fundamentals. And I just kind of wanted to get your thoughts on, what's happening in some of these markets. Why is soybeans moving higher now? What are the fundamental things driving this market? And then we can maybe talk a little bit about what the charts are showing us.
Yeah, absolutely. Well, one of the biggest things that we've kind of seen, and as we're kind of looking at it, one of the biggest things that we've seen here is on the WASDE report that came out last week. The United States Department of Agriculture basically told us that there was a greater than expected yield decline, and that because of that yield decline and the ensuing production decline, that even though we had a significant reduction in expected exports, the carryout did not expand at all, and so it kind of leaves traders a little bit concerned about what could be happening once these bin doors kind of slam shut here, and now we're 75% approximately harvested here now. With frankly relatively few opportunities to go out there and re-own these beans for merchandisers and commercials moving forward. Oh, you are muted.
Thanks, Josh. I was trying to avoid getting the sneeze on camera, so that hopefully I did that. I'm looking at the charts here today. Over the last couple of days, we've moved over $13 on the November, and we're even higher than that on the January. Do you think that $13 level is a psychological level where some buy orders might have been entered in? Do you think this is the start of a potential move, sustained move higher?
Well, I'm not going to tell you that it's not. For my way of thinking, I think that we will probably end up pressing just a little higher before kind of retreating here. Either possibly tomorrow, could be early next week. But I think that the market is going to want to go back down and retest that $13 level and kind of make sure that everybody's in agreement that it should kind of be marching higher from here. But I'll tell you what, producers have got to be incentivized to get these soybeans out and actually bring them to market. And I think that for a lot of folks, $13 is not moving the needle just yet.
Okay. I did notice that we are kind of moving from a shift, at least from an open interest side, from the November to the January. Where do you think, some good target levels for this move would be in the January beans? Would would 1360 be out of the question?
I really don't. I mean, there's a couple of different levels here that I think are probably important here. One of them is this 1339, 1340 level, which is really pretty close to that 200-day moving average. That 1340 level, which is actually now the 50-day moving average, actually. That level has been resistance here. We can kind of look back to that in late September. That was a point of resistance. And if we look back, on the other side, there's a corresponding support level in late August. And so that's actually a level that I would kind of be looking at is kind of that space just above 1340 that was support and has now turned into resistance, which is kind of why I'm looking for a little bit of a pullback, the market to kind of honor that resistance, and if it wants to go back up and push through there, then it absolutely can. But to really kind of give it some pause, give sellers their moment to kind of sell that resistance point, but before buyers go out and push to new highs.
Sounds good. Now soybeans obviously don't live in a vacuum. They produce two different products, one being soy meal and soy oil. Showing a chart here now of soy meal, which just looks amazingly bullish in particularly the last three sessions. Although if you go back to the 9th or 10th of October is kind of when it kicked off. What is happening in soy meal specifically, and is this one of the drivers of the soybean market right now?
I think it definitely is. Well, to me, the biggest thing that I've been seeing here over the past week is that soy meal offers in Brazil have been rising by about $5 per day. Really significant increases in the cash offers down in Brazil, and it kind of suggests that down there in Brazil that they're kind of coming to the end of what they can easily sell, comfortably sell where they're at. And this is for a couple different reasons. One of the biggest reasons is that the Argentinian soy dollar opportunity was really kind of a bust. Argentinian inflation now is in excess of 120% annual inflation down there, and so the soy dollar program, and for your viewers, the soy dollar program is Argentina's solution between the official rate, which is substantially lower than the unofficial black market rate. The soy dollar opportunity basically gets close to, but doesn't quite get to the black market rate. But the problem is that every time that they set something with such a rapid rate of inflation, by the time that it is ready to go, it's already moved backwards in terms of its competitiveness with the unofficial market, and there's really nothing that suggests that it's going to stop, and nothing really that suggests that it's going to hold steady. So for producers in Argentina, they're holding something that is inflation adjusted. It's sold in US dollars, and so for them, those soybeans down there are their inflation hedge, and for that reason, Argentina was really pretty spectacularly unsuccessful in prying those soybean bushels, tons out of those Argentinian producers' hands.
I'm gonna show a chart here of soybean crush margins, which, if I kind of toggle between this December soy meal and the December soybean crush margin, there's some very big similarities there. Anytime you see a rally like this in crush margin, I feel like there's an incentive for crushers to add some, at least on paper, some board crush to their books, where they kind of make hay while the sun shines, or something like that. So once you get crush margins, when crush margins expand like this, are there any negative ramifications to like namely the oil?
Well, so this soybean crush margin, I think that you've got bean oil perhaps even just as the
I do.
next chart here. We've seen in this move soybean meal rising, which, as you said, lays over that speaks to this crush margin really well. But we also have soybean oil moving backwards sharply. And so that's also assisting this soybean crush margin. It's kind of a 1-2 punch here for it's kind of a 1-2 punch for the vegetable oil, as well as obviously oilseed producers. Meanwhile, processors, right? This is only good for processors here at the moment. So, when I think of negative knock-on effects, in my opinion, it's just going to make particularly here in the U.S. Producers less willing to be selling here, as they kind of see that there's a significant opportunity out there that very well could kind of move back into their favor in terms of the processor not quite getting as much, because that's really what we're talking about here, right? We're talking about a processor buying a bushel of soybeans and then crushing it into its composite parts of soy meal and soy oil. And at the moment, as we moved from 138 back there on the 10th of October, excuse me, up to 200 today, that's basically been additional profit that processors are accruing, not to the benefit of producers.
Mm-hmm. It's interesting. I even look at the oil share of soybean crush, which I'll display here. It's dropped, or it spent a lot of time in the 40 plus area. 42 to 44% of the value of the crush was derived from the oil sales, and over that same time period where meal has risen substantially and oil has fallen, that has now moved down to about 38.8% of the value of the crush. So there's definitely a shift. Like a year ago, it felt like the world was short of vegetable oils, and that was the driver of crush margins. And now it feels like it's flipped.
Yeah, and globally, that's right. Globally, there is now a bit of a glut of palm oil. A little asterisk there, though. Palm oil prices are getting so low that the plants that they derive the palm oil from are not being replaced at replacement levels. So in the future, we very well might see a little lower palm production out of Oceania, the twin palm powerhouses of Indonesia and Malaysia.
All right. Well, I think we're this whole oil discussion is going to have some ramifications on Canadian canola as well. I'll probably get into that in a little bit here, but before I let you go, Josh, I wanted to get your thoughts on the corn market, which has been bumping up against a $5 glass ceiling there for a little bit, but punched above that today.
Absolutely.
There's still some resistance up here at previous highs in August. I don't know if you can see me writing with my pen here, but these highs are still below where it traded to today. So I don't know which is the more important level, the psychological level of 5 or this, I think, is even in the 100-day moving average up here. Are these resistance levels more important than the psychological 5, or was today's move a good indication of what's to come?
Well, I think that first of all, we have to look at what happened today, which was that there were rumors that China was buying or in the market for U.S. corn, and that would have been shipped out through the PNW. We don't know whether that actually occurred today or not. And even if it did occur today, we might not see it on tomorrow's flash sales, particularly if they spread the sale out. But that's really kind of what the market was responding to today, we really need to remain focused on the fact that for the U.S. domestic market anyway, there is still a pretty significant carryout. We're seeing the USDA predicting that we're going to be building from somewhere between a 1.3 and 1.4 billion bushel carryout all the way up to 2.1 billion bushels. So 2.1 billion bushels is not a tight number yet. However, on the other hand, there is some significant dryness that is beginning to occur down in South America, particularly in the northern and central regions of Brazil. This is very much in line with the El Nino phenomenon that is currently ongoing and is expected to continue through all of the southern hemisphere's summer and main growing season down there. So during that El Nino phenomenon, we see precipitation decline sharply in the Western Pacific and increase significantly in southern Brazil and historically northern and central Argentina. Up until now, we haven't really seen Argentina get in on the moisture story. They've really kind of been continuing to suffer from the La Nina drought that's really just persisted, even though La Nina was over this past winter. It's really just now that Argentina is supposed to start getting some moisture down there. Another note of caution on cheerleading this $5 corn too much is that Ukraine corn is still offered at a better value than U.S. corn is, and particularly China has been a main buyer of Ukrainian corn. So we shouldn't necessarily expect that China is going to be coming in here with some big significant corn purchases. Although if they do, it could portend that the Chinese know something about this war in the Black Sea region that maybe the rest of us don't.
There might be even an element here of some short covering as well, right? The traders had built a pretty sizable short position in corn, and whether it's profit taking or covering or whatever you want to call it, they did kind of set themselves up for a bit of a run. So it might be temporary, but it might be a good opportunity to add some sales onto the year.
Could really be short-lived. Expect short covering rally. I am personally expecting a bit of a short covering rally, perhaps in the overnight tonight and into tomorrow. But I would expect also, barring some additional bullish information or confirmation of Chinese purchases, that will set back and again go back down and retest that resistance that has been there. We can see it really clearly on your chart here in that red line. Go back down and retest that $5 level, perhaps flirting back down towards 490 again.
All right. Well, thank you very much for your time today, Josh. I'm gonna stay on and continue with wheat and canola for our Canadian listeners or viewers. But I really appreciate you taking the time. I know you're a busy guy.
Thanks again for the time, Brian.
You bet.
Bye-bye.
All right. I'm going to stay on here, and we're just going to talk a little bit more about wheat and canola. I'm going to start with the larger volume contract, and I think that there is some correlation here to corn. We did see Chicago wheat today move above some resistance. I do think this is a sympathy play towards corn a little bit. It did run into that 50-day moving average just south of 595, and as you can see, there's a really large stepped approach here to resistance. So it's really hard to call. It's one of those markets where a new high doesn't necessarily mean a runaway bullish story. So we want to, I'm keeping my expectations a little bit tempered here on this market, but this is the time of year where we do generally see a bottom. Sometimes that bottom can take a long time. Wheat tends to bottom more as a saucer or a gradual bottom, as opposed to say a V bottom like what we saw in say soy meal earlier in those charts. But this is still a positive development, and seasonally it lines up as well. And we may have kind of started to hit some of those low points for fob offers in the Black Sea and those types of things as well. Chicago wheat and actually all of the wheat markets are sold quite aggressively short as well. So there is an opportunity for short covering in this market as well. Now, we saw a pop in in Chicago, but we did see some gains today in Kansas. But as you can see here by this chart, we're still very close to trading near recent lows in the Kansas. Again, this is reflective more of the Black Sea market than anything else, as the 12.5 or the mid-grade protein is what is being offered mostly out of the Black Sea and mostly out of Russia. So it is kind of keeping a wet blanket more on the hard red winter wheat side than anything else. As far as Minneapolis wheat goes, I know that there has been a lot of cash market activity as basis plus futures have added up to, say, a nice round number of $10. I think that that isn't a bad price. I wouldn't dissuade anybody from taking advantage of that. I do think that elevators are reaching with basis in order to get there. So, it is a bit of a selling trigger for particularly for Western Canadian farmers when you see a nice round number like that. So it is a good place to have targets in. I would caution, however, that if this market is bottoming and we are going to see futures market rallies, that if you're going to feel regret after making that sale, if the futures market decides to rise, then you may want to have a plan B or some kind of over-the-counter contract, or if you're working with an FBN broker like Josh or somebody within the FBN brokerage, that you are having those conversations with them as well about regret if you are making cash sales. So just wanted to keep that in mind as well. As you can see, this Minneapolis market took a really big hit in that September 29th USDA report when the production numbers were reported significantly higher than expected. It hasn't climbed out of that rut yet, but we are moving above this 20-day moving average, which is a positive sign. That probably means we should be able to muster something up into that 750 area. But that's where we'd want to watch for failure of that area. The next kind of point of resistance there would be somewhere south of 790. I'd call it 780 just to be safe. So that's kind of the stepped approach there in Minneapolis wheat. Again, this is a seasonal time for wheat to try and bottom. Not that it happens like that every year, but we definitely have seen some pretty consistent seasonal trade throughout this crop year so far. All right. I did want to touch on canola. I'm glad that we went through the soybean and soy meal and oil discussion earlier with Josh. I think that is having a bit of an impact here on canola. Originally, when I saw what was happening in the market today, and I mean, when I made the morning commentary this morning, we weren't down significantly yet in canola. It started to happen mid-morning. But the canola market did do a bit of a fall apart today. And as you can see here, the November contract traded below. Not only did it trade back below the 61.8% Fibonacci, but it traded even below support at around 694 and traded and closed near its lows at 692. Now, a lot of people will be saying, hey, Brian, nobody's trading off the November anymore. It's just commercials and speculators in there, which is true. But we do have a similar thing happen across the calendar here. So this is all of the futures markets stacked up here. We saw $19 losses in November, $14.60 in January, $13.70 in March and May. So one of the things that does, right, is it not only does that mean there's losses across the board, it's not just focused on one contract, but it does strengthen or steepen the yield curve or the carry in the market that has occurred, which is a bit of a bearish signal. So I think I have a chart on that in a little bit. I'm going to get into that in a second. Here's the January canola. Again, this is the settle price, 705.20. As you can see here, that Fibonacci was at 705.60. So it closed just below that Fibonacci test. Do I consider that a break? Uh, Not necessarily. It's possible that we will rebound off this area technically, but if it doesn't, and I'm not just thinking about tomorrow. I would be, concerned about it doing so. Even, tomorrow, realistically, we'll probably see a bit of a bounce tomorrow. I wouldn't necessarily say the risk is over though if we do bounce tomorrow, unless we erase these gains or these losses completely tomorrow. That might be a different signal. But if we just see some marginal gains tomorrow, end of week, counter trend trade, I still think we should watch into Monday, Tuesday, Wednesday of next week to see if this pattern of lower futures overall continues, because this kind of trade today does say to me that the market is willing to sell it down there, which is a bit of a risk at this point. We did see some pretty strong farm deliveries this week. Um, I don't necessarily think that this is a building of inventories. This is pretty seasonally normal, as you can see here, about 450,000. I don't have the exact number, but a good week of farm deliveries. The visibles week over week did rise slightly, but again, nothing out of the ordinary. Actually, it's low relative to averages and even to last year. So that's not concerning to me. It's not like farmers are delivering overwhelmingly into a system that doesn't want it at this point in time. So I do think we're going to see a pretty strong crush number come out at the end of the business day tomorrow. Copa releases their data at about 3 o'clock, or I think it's 3 o'clock Central Time on Fridays. Here's what that canola crush looks like the last couple of days. 2 weeks ago, we saw 97.7 crush capacity utilization. That was about 226,000 tons of crush in 1 week. Last week, that backed off a bit to about 212,000 tons. Still a good week. I consider anything, this is kind of the 90% capacity utilization mark. Anything above that, I think, is good and healthy crush. This is seasonal lows as we were kind of getting out of October. So I wouldn't be worried necessarily unless it started drifting, down below 200,000 tons a week. That might signal that either there's not enough supply to crush or the demand for such has decreased. But still, nothing out of the ordinary there. And I think crush is still healthy. Weekly exports. Today's exports of over 200,000 tons were actually the largest export to date so far this crop year. As you could see, that's still well above averages and well below averages and significantly below where it was last year. So these aren't overwhelmingly positive. I still feel like this kind of showcases how poor the demand is for canola overall from the export market, and that the demand pull is really being done by the crush. Here is a so kind of going back to canola. I think that there still is a correlation with canola and soybeans. I think soybeans rising is overall helpful, particularly if we see it start. I don't necessarily think that the fundamentals that are affecting soybeans right now are necessarily driven solely by South America. But if the South America story does pick up, I think that there's still an opportunity for canola. But what this market is showing us as well is that there is a very large disfavor towards vegetable oils right now. And it is even becoming less and less important in the crush margin aspect of it, as you can see by the crush margins that we saw earlier. I did want to end off with one interesting chart as well today, because we have talked about this for a while, which is the U.S. 10-year notes. It hit almost 5% today. A little bit scary as far as how much stress banks can take at high interest rates like this, and how much devaluation of bonds that can happen, which before causing stress. This is a little bit of a red flag from an economic standpoint. I don't know if that necessarily affects the commodities, but I know we have been sharing this chart in our morning commentaries and in these charting points videos as well. So I wanted to show it because it is an interesting chart, and we are getting to the point where we are nearing 5% 10-year yields, which is pretty crazy. We haven't seen that since 2007. All right. That is all we have for you today. Thank you very much for joining us. We will see you again next week, Tuesday. Have a great day.